and I hope you have the latest slide set handout. We are moving to a new session today on financial markets and securities. Sometimes call them as products, and this is actually the part one of this discussion, and there will be another uh, slide set in a different week. So today we basically look at the financial markets and instruments. Now we have already covered financial institutions. Now probably you may remember I was telling you when financial institutions are basically interacting in the financial system, that can happen through financial markets as well as using financial instruments. So these institutions, markets, and instruments cannot be, discussed in isolation. All are basically connected. So today we will be looking at the markets and instruments. We can define financial markets as the where a kind of a situation individuals and institutions are meeting together to trade financial assets. So it can be a physical place, or it could be a virtual place, or it could be even through mode of communications. It's a kind of a place or an kind of an instance or situation where institutions and individuals are meeting to trade financial assets. So these financial assets we can call them as instruments or products or whatever. There are various terms that you can use. But what you are doing essentially is you are exchanging financial assets in the markets. Now, why do you exchange or trade these financial assets? Now, in the markets or institutions, wherever we know in the financial system, people are basically channeling funds from one end to the other. So it could be from lenders to savers, from surplus units to deficit units in a broader sense, or surplus units to deficit units, or from lenders to borrowers actually. Right? Lender and saver are the same. The borrower, the spender are the same. So this is a kind of a channeling of funds to this particular sector that the financial markets are helping to channel these funds. Now, when you channel these funds from one segment to the other, uh, depending on the type of the market, depending on the nature of the instrument, nature of the requirement, instruments traded in the market could be different. As you are aware, there are various financial instruments. We will discuss in detail in a separate session or maybe later. Those instruments are diverse depending on the need and the preference of the financial market players. As you are aware, there could be some financial instruments like loans. There could be bonds. There could be stocks. Likewise, different instruments are available. These different instruments are fulfilling different requirements of the financial system or different needs of the financial system. Why financial markets are important for us? Now we know why financial institutions are important, why financial intermediation is important. Similarly, why financial markets are important. To understand that, we have to understand their key functions, their significance. Financial markets are important to provide price information about financial assets. As I said, financial assets are traded in the financial system. So when you trade financial assets, there are people who supply financial assets, there are people who demand financial assets. Through this supply demand mechanism, the price for the financial asset would be determined. So in a market where you have free functioning of the these two different segments, eventually a price would be determined. So when a price is determined, that price is a kind of we call it a market price, market clearing price. So that market price is basically determined through through the interaction of the financial market players who are dealing with information. People or investors in the financial market, they are basically looking at the information. Based on the information, they do trading, buying and selling instruments. So information is really important in the financial market. So information on financial assets are provided through the financial market. That is one important thing. Second, it provides liquidity to financial assets. Liquidity means, I mentioned to you a couple of times, the marketability of a financial asset. In other words, the possibility of converting a financial asset into cash simply. So this liquidity is really important in a market because that will keep market active. If you really want to trade a financial asset, you should be able to trade it very quickly. If you want to buy a financial asset from the market, you should be able to buy it quickly. So this buying and selling financial assets happening quickly means they are liquid. So that liquidity is provided through the market. We know in a market you trade financial assets. So that marketability is provided by the financial markets. Financial assets are also helpful in reducing cost. What is this cost? Cost of buying and selling financial assets. So you need to have you need to incur a particular cost when you are buying or selling a financial asset. So that cost is a key factor in your profit. If you are basically incurring a high cost in financial transactions, your profit margin, your profitability will be reduced. So always you try to have a best price in the market or the best cost in the market in order to optimize or maximize your profit. So financial markets are helping to reduce this cost. What is this cost? Buying cost of a financial asset and a selling cost. So when we say the financial markets are helpful in reducing cost, what type of cost that we are looking at is search cost and information cost. Search cost indicates the time and resources that you are spending to find out a suitable trading partner. In order to have a comprehensive, a successful transaction, profitable transaction, you should have a suitable trading partner. The suitable trading partner has to be explored. You have to find out. Financial markets are helping to find out this partner. And then information cost is involved. What is this information cost? When you buy or sell financial asset, you have to assess merits or demerits of this investment. You have to make an evaluation, appraisal. That appraisal or evaluation happens through basically information. So you have to have relevant information. So the financial market is flooded with information. They have a lot of information. So this information can be used in your financial decisions. Fourth one, financial markets are helping to promote efficiency. Efficiency by producing efficient capital allocation, which increases the production. Now, efficiency is an important concept in any economic context. It could be economy broader, it could be a financial market, it could be firm level. it could be financial institution, wherever we talk about efficiency, which relates to efficient allocation of resources. In the financial market, you should be efficiently allocate resources for productive purposes, and that will increase the production. So financial market will give you a lot of opportunities and chances to make your investments in relation to the supporting the real economic activity. So in that matter, you need to have efficient financial markets. Now, financial market efficiency, it's a theoretical concept. I'm just presenting you this concept here for you to get some understanding about the efficiency. Now, what we talk about efficiency, as I said, how quickly the markets are basically responding, acting, and doing a financial transaction, which will lead to maximize or optimize your return. So that is in general what you mean by efficiency. Theoretically, efficiency is related to information. Now, there is a famous hypothesis called efficient market hypothesis, EMH. This EMH was proposed by one of the Nobel laureate economist person called Eugene Farmer. So Farmer, he presented a model or a discussion on efficient financial markets. So what he meant was, referring to efficient financial market, is the financial transactions in the market are happening based on the information. I told you, no, buying and selling assets relates to information. You need to look at information. You should have appropriate information to make a decision. So according to Farmer's argument, he said, in an efficient market, prices will always fully reflect the available information. A particular price determined in the market reflects all available information. I told you, no, financial market transactions are happening based on information. You have to have information. You need to assess information. You need to make decisions based on information. So for that matter, you have to have available information, and in an efficient market, that information should fully reflect the available information. Why this is important? Farmer mentioned, when the markets are efficient, when information is reflected in the prices, investors cannot beat the market, or investors cannot outperform the market, which means you cannot earn abnormal profits. Now, profits are welcome. We talk about profits, and there should be a reasonable profit. So those we call them as normal profits. But there are situations, financial market players they are trying to exploit abnormal profits. Abnormal profit means based on your average profit level, what you earn above that. It's a temporary situation, and abnormal profits are basically sometimes it's disturbing the markets. So we talk about some long-term profit, average profit, normal profit. That is basically possible when the markets are efficient. Efficient means you don't have people who are going against the market. The market reflects available information, means everyone is basically following the market conditions, or they are basically in line with market conditions. So this situation Farmer referred to as the efficient market hypothesis, EMH. Now there are three basic levels of efficient market hypothesis. The first one in this simple illustration, the middle circle is called as weak form efficiency. Weak form efficiency. If a market is weak form efficient, the argument is all prices at that point, the prices available in that market reflect all historical information. Historical information means historical prices, return information, etc. etc. We have historical information, we gather data, we prepare databases, we have reports, we publish, we do analysis. All these are based on past data. So if past data is used in the analysis, or if that past data is captured in the current prices, you call it as a weak form efficient market. Semi-strong efficient market means the outer circle of the weak form, the light blue one. There, the prices should reflect all available information, all public information. All public information means whatever, not the past information also, current information even. For example, company reports, annual reports, company prospectus, company financial details published in papers or wherever, rating reports, credit rating reports. All these are considered as publicly available information. So if this publicly available information is captured in the price, you may call it semi-strong market. In most cases, what we observe is semi-strong market. The outer circle, we call it as strong form. There we have all public and private information. If the market is strong form efficient, there we should have all available information, whether it is private or public. All available information should be there. So what are these all available information? We already know historical information should be there. Also, this public information should be there. Whatever published as data or information. Also, third one, there should be private information also. Sometimes private information is there, which means the director board only have some information. Only the company management have some information. So this information we call it as private information. So if the market is fully efficient, 100% efficient, there we observe strong form efficiency. But usually a strong form efficiency is a kind of a theoretical concept. Sometimes you may not observe that in practice or not in practical scenario. Okay. Any questions up to this point? All okay? Can we move?
Yes, sir.
Okay, thank you. Right. Next point, I think last week we discussed in detail risk faced by the financial institutions. Now today we repeat a kind of repetition of the same discussion to understand financial risk. Financial risk is generally referred to as the possibility or exposure for potential losses. In other words, you can call it uncertainty of a return and the potential for a financial loss. Risk, I think when we were talking about risk, I told you risk is uncertainty. You don't know whether it will happen or not. There is a possibility. Risk is everywhere. Generally, risk is uncertainty. Financial risk means uncertainty on what? On the possible financial loss. We are dealing with financial assets for a purpose, to make profits. So there could be some risk that you lose such profits, or you may not be able to earn any profit. You call it uncertainty of the returns or financial risk. Financial risk is a kind of a term used to identify multiple types of risk. You cannot simply straight away define financial risk. Financial risk is a combination of various risks, multiple of risks, which can arise due to various factors. So what are these multiple risks? At least broadly, financial risk can be categorized into three major risks. Financial risk can be categorized into three major risks: market risk, credit risk, and liquidity risk. I think I discussed last week also about these different risks under financial institutions. So basically same definitions can be used, but we are basically looking at the market. So our examples or the way of defining could be linked to the markets. So financial risk we divide into three. The first one being the market risk. Market risk is the possibility of fall in value or price of assets traded in the financial market. So there could be possibility that you experience value loss or price drop of a financial asset. For example, if you are holding a bond instrument, you have a risk that you might lose the value of this bond, or you might lose or you might make losses. If you have a share of a company, there is a possibility that you may lose the value of that share if share prices go down. So likewise, the market risk indicates the change in value or the price leading to losses through financial instruments. Market risk we can divide. I think last week also we discussed these things. At least we can identify two broad categories: exchange risk, interest rate risk. So there could be changes in the exchange. We know exchange rate and interest rate, they are prices in the economy. Interest rate is the price of domestic money, exchange rate is the price of international money, right? So foreign exchange. So the exchange rate risk means the possibility of losing value of the assets in foreign currency due to variations in exchange rates. You have particular exchange rate tomorrow, you make a certain gain out of that. If tomorrow the exchange rate would change, probably you may make losses. That loss is arising due to exchange rate changes. So possibility of such changes causing damages is exchange risk. Then interest rate risk. Again on the same line, there could be changes in market interest rates. So when market interest rates are changing, financial asset value is changing. For example, interest bearing instruments will have change in their value. For a bond, you have an interest. So when interest rates are changing, the bond price, the value of bond will change. Okay. Then we have credit risk. Credit risk means, I think we discuss under financial instruments institutions as well. That is basically possibility of the borrower not paying the amount or including the interest. The borrower does not pay any principal or interest to the lender. You call it credit risk, or sometimes you call it default risk. Default risk. So there's a possibility that debtor might not pay. Debtor might default. So risk arising due to such defaults can be termed as credit risk. Credit risk. Under credit risk, you might have insolvency risk, some other types of risk as well. But broadly, what we are worried is credit risk, which is the default risk. Third one, liquidity risk. I think we already know liquidity means the ability of turning into cash or converting into cash. When you face liquidity risk, you might not be able to sell or buy your assets quickly. So if you are only able to sell your assets or buy assets quickly means when the market conditions are favorable. If you can do it, you can make profits. Otherwise, you have a risk of losing the profit. So the problems arising due to the loss of liquidity or due to collapse or problems in liquidity leads to liquidity risk. Okay. Then risk return relationship. Risk is the uncertainty. Return is what you would like to have out of this investment. Sometimes return you may call it as profit, but there's a difference between return and profit. I'll come back to that later. But basically what you are looking here is the relationship between what you earn and the risk that you face when you're earning. Now generally in finance what we have seen, there is a risk return trade-off or relationship. We know when returns are higher, that returns are subject to high risk. In other words, greater the risk, greater the return to investors. Why is that? Now, generally, return is used to compensate for the sacrifice of funds. So when you are making an investment, that basically you are sacrificing funds which can earn something else based on some other investment. But you sacrifice it because you would like to have a return. Generally, people would like to have higher returns. They would like to have not 10, 15 return, maybe 20, 25, 30 plus return, because private firms, they are basically looking at higher returns. The problem is such higher returns are linked to high risk. High risk means we already know there is a high probability that you lose money, that you make losses. That is basically high risk. We know theoretically, or at least not in theory, even in practice, when you can earn substantially high profits or high returns, that is really associated with risk. Now, for example, let's say people are after high interest rates from finance companies. Some finance companies, they offer high interest rates. So what does that mean? That high interest rates are followed by or associated with high risk. Sometimes the high interest rate may not be a reality. You cannot pay such high interest for a longer period. So that is basically linked to a certain risk. So this risk return trade-off is a very common thing in finance. So here if you look at this chart, even the second chart, even the third chart, everything would be the same. When you go top into this risk return pyramid or the investment pyramid, the top part is the most probable, most uncertain, risky part. Some instruments can be placed here on the top as risky investments. For example, stocks. In this simple chart, I have put stocks. So stocks are having high risk. Why? Stocks are changing, prices are changing due to market conditions. So they have high risk. Some instruments are having low risk, like deposits. In the investment pyramid, the base, the lowest part is like less risky investments, like deposits, or it could be treasury bonds. They are having relatively low levels of risk. So this risk pyramid is, or investment pyramid is giving an idea on which investments are risky, which one are less risky. Now, generally, if you look at the top chart, I have given you the relationship in general with the risk and return. Now, T-bills, if you look at this chart, there are 4 sub-points connected to each other. What we have here is the annual return average. Annual return average means what you earn. Then annual return standard deviation means standard deviation is used to measure the risk. In statistics, the standard deviation is called as a measure of dispersion. How much you are away from the equilibrium or mean is measured by the standard deviation. So here what we have, why we have standard deviation here, that's to measure the risk. So if you look at this chart, the risk relationship a risk-return relationship can be observed. Now the lowest point is T-bills. T-bonds basically in the middle. Large company stocks, they are middle but above T-bonds. Small company stocks, they are the highest return, highest standard deviation. So this clearly indicates some instruments are having low return because their risk is low. Some instruments are having high return because their risk is high. Generally, T-bills that's secured by the government. You don't have a risk. But if you look at company stocks, they are very risky. Why? That is related or linked or decided through the market activities. So here there is a clear relationship between the risk and return that we need to understand. Now, when there is a risk, there should be a way that you can reduce the risk. So this risk reduction process you call it as diversification. Diversification. What do you mean by diversification? Simply, diversification means you are expanding the available investment opportunities, or you are expanding your portfolio by bringing various assets to reduce the risk. Now, word diversification indicates you have many. In financial market, the diversification with a view to risk reduction indicates that you can expand your portfolio in order to reduce the risk. Now, if you look at this chart, in the chart what we have is on this axis standard deviation. Simply the vertical axis has standard deviation. Standard deviation measures in statistics the risk. So risk is given by the vertical axis. Horizontal axis what we have is number of shares in the portfolio. So if you look at this chart, you will see when you increase number of shares or number of instruments in your portfolio, your risk is reduced. Now we have this curve as a diminishing curve, reducing curve, which means when you add more and more shares into your portfolio, securities into your portfolio, for example, 1, 6, 11, likewise, if you expand your portfolio, you reduce your risk. Why you are reducing your risk? I think you may have heard this very, famous term. Don't put all eggs into one basket. If you put all eggs into one basket, there's a possibility the basket fallen and your eggs will be broken. So it's really recommended if you have too much eggs, you should use different baskets. Similarly, in finance, in your basket, which means your portfolio, if you have different financial assets, you are reducing the risk of financial loss. You can reduce the financial loss or the risk by way of diversification. So if you look at this chart very carefully, we have clearly mentioned how the diversification reduces the risk and how it forms portfolios. Now, if you look at this chart, you might have some, interesting observations. I think someone might have a good observation on this chart, especially on the horizontal axis. What you see? What is your assessment? Do you see any difference or any special message of this chart? Any idea? If you look at this chart, what can you observe? It's reducing, which means risk is reduced through diversification. What else? Any observation? Any suggestion, observation on this? I hope you can hear me, right? Enlarging, okay. Sayanash says enlarging its range of products of field of operation. Okay, what does that mean is basically when you go along the horizontal axis, you will see the number of assets are increasing, the financial risk is reducing. That's correct. What else? There's an important observation. I'm just trying to get you to a discussion because I think you are sleepy. I'm also sleepy. What do you observe here? We usually have a very interactive group. Today I think very silent. Why is that? What's the reason? Is anyone having a good observation on this chart? Shall I show it again? Let me show it. Okay. Now someone said, okay, there is an expansion of the assets and basically the coverage of the or the diversification, and you reduce the risk. But in addition, there's one more important observation. If you look at this chart, who would like to make that observation? Who would like to talk? Is anyone having an answer? Let me check the chat box. No one. Investment grade bonds at diversification. Okay. I think what you are saying is when we diversify, we look at good investment opportunities, right? We look at, investments with good grade, A grade, A plus grade, likewise. So that's true. When you diversify, you have to look at different uh, good opportunities. That's true. Still, I didn't get what I need actually based on this chart. If you look at the very right end of the curve, what do you observe? Let me show it again. When you look at this right end of the curve, what can you observe? Hmm? Why it becomes constant? The reason is very clear. It becomes constant because the diversification cannot bring risk to zero. In other words, even though you diversify, you reduce the risk, you cannot bring it to zero. There's nothing called zero risk. Risk is there. At least some part of risk will be there. So through the diversification, you are able to reduce risk, but it will never reach zero because even with the diversification, there will be some amount of risk. For example, due to economy-wide issues, inflation, growth. Likewise, there could be various reasons that you will not be able to reduce risk to zero. So that part of risk, which means even if you reduce, even if you diversify and reduce risk, still there will be some risk. That risk is called as systemic or sometimes systematic risk. I'm typing on the chat box. So this part is called as systematic risk. So if you go back to the chart, you will see there is some risk. It doesn't come to zero. So curve becomes flatter. There's some risk means this particular risk is called as the systematic risk or systemic risk. That is there. You cannot avoid risk completely. So I think you are clear. When you increase number of assets in the portfolio, you are reducing risk. Now, why it happens when you increase? Why your risk is reduced? You have a portfolio. The word portfolio means you have different assets. You have number of assets. So when you have a portfolio, let's say you make loss from one asset, but you make a profit from another asset. Now, here in this diagram, we have a kind of portfolio. What do we have in portfolio? We have real assets, cash, gold, stocks, government securities, mutual funds. Likewise, you have various instruments in your portfolio. Let's say your gold prices go down. You are making a loss. But overall, you don't make a loss. Why? Because your other investments are doing okay. Let's say your government securities are making a loss. But still you are okay because other instruments like cash, savings and all that, they are making a profit. So that's the importance of diversification. And there are methods of reducing risk other than diversification. One important concept related to this is hedging, a way of reducing risk. Hedging is a kind of a method that you can reduce risk against one important thing, adverse price movements of an asset. So adverse price movements of an asset will lead to losses. Remember, we talk about market risk. When interest rates or exchange rates are changing, you may make a loss. Those are adverse price changes. So those adverse price changes can be addressed through the method called hedging. Hedging means you are using some instruments as a risk management strategy. These instruments, like, we can call them as derivatives. So derivatives are basically helping to reduce the risk of uncertainty due to these price changes of the asset. So if you look at this hedging chart, you will see what are the areas that you can hedge. You can hedge against commodities, securities, currencies, interest rates, even against weather. You can have a kind of a hedging. Hedging means a protection. What are the instruments that you can use? Forward transactions, future transactions, money market transactions. Likewise, you can use different instruments, types of instruments and strategies to make a hedge against a price change. So I'm not going to discuss what is forward, futures and all that, because I have a session on that, on different financial instruments used as hedging instruments or risk management strategies. Okay, before I move to the next part, any questions? Why is it called hedging? Hedging means, as I said, it's a kind of protection. Hedge means you are hedging, means you are having a protection. Protection against price changes. You are trying to avoid the price changes. Any other questions? Any other questions, please? Can we move to the next part? Okay. Now let's classify the financial market, which means we can look at various groups of financial markets depending on the various characteristics. Now, if you look at this right hand side chart, you will see there are a number of financial markets: stock markets, bond markets, commodity markets, money markets, derivative markets, I just mentioned, futures market and all that, insurance market, foreign exchange market. All these are financial markets. These markets, depending on their nature and the characteristics, we can classify into various categories. What are the types that we can use, or the broader areas that we can look at in classification? We can look at the nature of the transaction, nature of the instrument, maturity of the instrument, timing, operational structure. So I think in the following slides I have the definitions, but here we have simply the classification. So how do you classify based on the nature of the transaction, whether it is a debt market transaction or an equity market transaction? Debt or equity, it's a matter of the type of instrument. Maturity of the transaction, which means short term or long term. If it is short term, you call it money market transaction. If it is long term, you call it capital market transaction. Now these capital market transactions, again, you can look at whether it's a primary market or the secondary market. Primary market and secondary market is basically the timing of, not the timing, how can I say it? Primary and secondary indicates whether it is for the first time or it's a repetition of the transaction. If it is first time, the transaction is in the primary market. If it is a repetition, maybe it's in the secondary market. Timing of delivery. When are you going to settle the transaction? Delivery means settlement. If you buy a share, it has to be transferred under your name. When this transfer happens is delivery. Sometimes it happens in the cash market. Cash market means on the same day or immediately. Futures means not same day or immediately. It takes some time. So that is the time of delivery. Organizational structure of the market means whether it is an exchange market. Exchange means it's a kind of an organized market, or it is an over-the-counter market. I'll have the definitions. Over-the-counter means it's a kind of an informal market, not informal. It's not that organized type of market. Okay. So let's look at these things in detail. First, primary and secondary market. So primary means simply the new issuance of securities or raising of new funds for the first time. How do you raise new funds? You have to issue a financial instrument. Either you issue stocks, either you issue bonds. Through this new sale of instruments, you raise or you obtain funds. Through the sale of new funds, new instruments, you raise funds. Now in the stock market, this new issuance of the instruments or the shares, you call it IPO, initial public offering, in the stock market. So in the stock market, when the companies are issuing their shares for the first time, you call it IPO, initial public offering. In the government securities market, again there is a primary market. What is the primary market? In the government securities market, the primary dealers go and buy from the central bank. They buy treasury bills or bonds from the central bank directly. So that is primary market for government securities. So whether it is the stock market or the bond market, bill market, what happens? Funds are raised by issuing instruments for the first time. Secondary market. What do you mean by secondary market? In the secondary market, already issued, already purchased traded transactions are exchange again, or you are selling and buying what has already been issued. For example, you have a stock, a share of company A, you want to sell it, so you should go to the primary market. You are a bond holder, you have, let's say, 100,000 worth of bonds, you want to sell it, you are selling it in the secondary market. So primary market generally facilitates the issuance of instruments. The secondary market facilitates the trading of the instruments. Okay, clear? Then, as I said, based on the type of the transaction, we can divide into debt market and equity market. Debt market means in the market, new debt is issued in the primary market, or debt securities are traded in the secondary market. What do you mean by debt? Debt is a contractual agreement between the lender and the borrower. So what is this contractual agreement? In the debt instrument, let's say you have a bond. For that bond, you have a contractual agreement. What does that say? It says the holder of the instrument is eligible for a fixed amount of money until the maturity. If I am issuing a bond, I am liable to pay money for that bond. To whom I'm liable? I'm liable to the holders of these bonds or the investors of these bonds. So it's a kind of a contractual agreement. Usually bond market is also referred to as the credit market. So in that market, you have various types of instruments: treasury bills, treasury bonds, corporate bonds, mortgage-backed securities, money market instruments. All these are referred to as bonds. Why? They are actually loans based on the principle of loans. Could be short term, long term, immediate or intermediate term, as different maturities are there. So here in this diagram, the types of debt instruments are given. Debt instruments can be classified, as I said, long to short and medium term. Long-term bonds are actually bonds and debentures. Short-term instruments are basically money market instruments. Sometimes you call it, treasury bill market. If you look at the money market instruments, there are a number of instruments. There are notes, treasury bills, CDs, commercial papers, repurchase agreements. All indicate some medium to short-term nature in the transactions. Bond markets are generally considered as long-term market. Even the debentures means private debt instruments, private bonds. So debt means, I think you have some idea, it's a contractual agreement to pay in future. Equity means what? It's a bit different from debt. In the equity market, you have a number of buyers and sellers of stocks or shares. So it's an aggregation of buyers and sellers of the stock. In this aggregation, you have various type of shares from various companies. We call as stock market or equity market or share market, whatever the term, we are talking about the same thing. What is this stocks are? Stocks means what? Bond, I told you, it's a contractual agreement. Stocks are some kind of a assurance or a certificate to show that you are eligible for a part of the net income and assets of the business. Net income means the profit. So the stockholders, shareholders, they are having some right, they are having some opportunity to claim for profits as well as assets of the company. So these stocks are listed in the stock market, and when you have stocks, there could be some periodic payments. Periodic payments means dividends. So a stock would have two types of income streams. One, the price change and the capital gain. I'll show you that in a separate discussion. Due to changes in prices, you might have a capital gain. That is one type of income. The other type of income of a stock is you might get dividends. Dividends means distributed profits. If you are a shareholder, you also get a part of it. And generally, equity markets are considered as no maturity or long-term instruments, because in the stock market, you don't have a maturity. In the bond market, you say, okay, this particular bond is 5 years, 10 years, 15 years, likewise. But in the stock market, you don't have a particular maturity. You cannot say a particular stock is maturing on this date. It's not. They are long-term instruments. Sometimes you call them as perpetual instruments, perpetuities, which means long-term instruments with no maturity. Any equity holder is a residual claimant, means when the company is bankrupt, the equity holder will get their funds at last. If they have borrowers, if they have depositors and all, they have to pay first. Then only they can look at the equity holder. So he basically gets a residual claim. He is basically a residual claim. So whatever is available left will be allocated to him. So here I have basically given you some information. The stock market, as I said, it could be secondary market and primary market. In the primary market, you have IPO, initial public offering, I mentioned to you. In the secondary market, you have trading, where the stock market is applicable. In the stock market, mostly the secondary market transactions are happening. Then, by looking at the maturity tenor, we can divide whether it's a capital market or a money market. Money market. So capital markets, generally it includes instruments with maturities greater than 1 year or more than 1 year. I think you already have some idea. The capital market is something is long term. So as a result, the instruments traded in the capital markets are more than 1 year. I just mentioned to you treasury bonds, corporate bonds, they are having long-term maturity dates. So obviously they are capital market instruments. Why do you need capital market instruments? Companies can run their business using short-term, availability of money for the short term. But if a company wants to expand, in order to have better service, they would need funds which will be raised in the capital market. So capital market is roughly long-term funds are generated. What are these different instruments? I think you already know. I mentioned treasury bonds, private bonds like debentures and their instruments, other instruments, equities, even shares. We include them under the capital market because they are long-term instruments. Who are the issuers? Government can issue government bonds. Banks can issue their own bonds. Corporates can issue their private bonds. Likewise, they are the main issuers. I think in any country, the most significant important issue of capital market instruments are the government. So here I have given you a simple diagram as to how to divide these markets. Financial markets can be classified as capital market and money market. The capital market can be classified as stock market and bond market. I think you have some reasonable idea. Then capital markets are long term, money markets are short term markets. What happens here is in the short term market, that's basically less than 1 year. In this market, for day-to-day liquidity needs, in the capital market, you need funds for expansion, long term. But in the money market, you need funds for daily activity. You need to have more liquidity there. So how do you manage liquidity in the money market? The money market transactions are happening. There are various money market transactions. Call transactions are there. Repo transactions are there. Likewise, for targeting the short run, there could be various instruments. So in the money market, what we observe, the major observation is large banks are participating in this money market activities. In the money market, they do transactions in large volumes, even in Sri Lanka. In the coal money market, but the best example for a money market, the banks are playing a bigger role and in large denominations. Huge amount of money is traded. Have low default risk. In this market, it is considered as low risk because everyone has to be in the market. So if someone defaults, I think that is the end of that particular play. Therefore, everyone in the market tries to behave well in the money market. That is basically to make it an active, efficient. So what are the money market instruments that we are talking about? Treasury bills, repurchase agreements, commercial papers. Those are the main three. Bills, repurchase agreements, sometimes you call it repo transactions, and commercial papers. These are short-term instruments. Then the type of delivery, I told you, when would be the settlement? So one market, you call it spot or cash market. So in the spot or cash market, the transaction happens and the delivery happens immediately. Delivery means if you buy a treasury bill, you have to get the ownership of the bill. If you buy shares, you have to get ownership of that share. If you sell, you have to transfer the ownership. So that happens in the spot market or cash market in a very shorter period of time. For example, the maximum period for the stock market is T+2. T+2 means you do the transaction today. In 2 working days time, you have to settle it. you have to settle it. You call it immediate delivery or spot market or cash market. Derivative market means it is delivered or settled in a future date. For example, in 1 week's time, in 1 month time, 3 month time. Likewise, you enter into a transaction today, but you settle that transaction in the future. I told you the term derivatives, the word derivatives, these are financial instruments. These derivatives are best examples for this derivative market where you have immediate, not immediate delivery, future delivery for the financial assets. Probably you may have heard some terms like futures contracts, options, swaps. All these are derivative market transactions, not for immediate delivery, but for future delivery. Could be 1 week, 1 month, etc. Why this derivative market is important, as I said at the beginning, under hedging, these are helpful to manage risk. In finance, there is an inherent risk, we have to control it. Right? So when you control it, you can use these derivative markets to prevent any speculation. Then another type of classification is auction markets and exchanges, OTC markets. Auction market, or we call it exchanges, both are together. Auction or exchanges. In an auction, you know how it happens. Buyers and sellers are entering or coming with competitive bids and ask prices. Buyers are coming with a bid price. Bid price means what they want to buy. Sellers are coming with a ask price. Ask price means what they want to have. So the transactions between these buyers and sellers determines a particular interest rate, a particular price in this auction market. So it's a kind of an active market where the prices are basically determining the transactions. So price is having a high role in these auction markets. So it happens usually in a central location. That's why you call it auction or an exchange. For example, in the securities exchange, the stock exchange, you have auctions for government as for private shares. At the central bank, they have auctions for their government securities transactions. So there is one type of markets. The other variant is basically the OTC markets, over-the-counter market. So OTC means over-the-counter market means it's a kind of a decentralized market. Now in the auction market, it is centralized. Why it is centralized? Here I have written as central location because it's centralized. An exchange is a centralized place. But in the OTC market, it's a decentralized market and there is no physical central location. There could be a location, but it's not for, it's not material. So market participants are trading with one another through various communication modes. So communication channels are playing a bigger role in the OTC market, especially nowadays, especially the mobile and the telephone and the computer. So the telephone and the computer is really helpful for this market because it entirely operates on communication. So in the OTC market, dealers are acting on behalf of the customers. Best example is foreign exchange market. In foreign exchange market, the foreign exchange dealers are acting on behalf of the customers. So on that count as well, in the financial system, the foreign exchange market is the best example for OTC markets, where without listing in any organized market, the transactions are happening at a large scale in the foreign exchange market. So here in this diagram, you will see OTC market has no central physical location. You cannot specifically say there is the OTC market. It's through communication via telephone to do trades. For example, party 1 communicates with party 3, party 2. Likewise, you have communication via various channels like telephones or mobiles or whatever. Right? So this is how the over-the-counter market, OTC market works. In addition, I think these 5 different types of markets, which I have mentioned here, are the key. Debt market, equity market, money market, capital market, cash market, future market, exchange market, over-the-counter market. These 4 different classifications are important, and even the primary market and secondary market I discuss for your understanding. Now, in addition, those are the main features and characteristics that we can use in classifying the markets. In addition, you may have observed retail and wholesale markets. So retail market is basically the retail financial market is for daily operations. It's a day-to-day banking or savings credit facilities provided by a bank. You can call it retail banking. If they are providing services for large quantities or large quantums or large foreign entities, we may call it as wholesale transactions. So that also matters. Retail financial transactions and wholesale financial transactions. Then let's move to the foreign exchange market. Now, if you look at our previous classification, I did not specifically talk about foreign exchange market in that classification, but here we are just going to discuss foreign exchange market in detail because this is really important. I have taken it out separately to have a brief discussion on the foreign exchange market. Okay. Before that, let's get a kind of a 2-3 minutes break. Don't go away. I'll come back very soon. Let's start again. I just wanted to grab a book. Now someone is asking, is OTC market are also known as pink sheets? Cyanesh, yes. Yes, in some cases they call it pink sheets, pink companies, pink sheets. I think that is related to over-the-counter market. But it's like a, it's a very casual word. The formal word we use is actually the OTC transactions or the market. Let's talk about the foreign exchange market. This is a kind of bit lengthy discussion where we look at some of the calculations as well in relation to foreign exchange market. Foreign exchange market is very, I think, famous market and very important market in many countries. Even in Sri Lanka, the foreign exchange market has attracted a lot of attention because of the exchange rate. So the exchange rates are determined in the foreign exchange market. So in the foreign exchange market, there are various names for that. People call it forex market, FX market, currency market. So these different terms are used to recognize the transactions happening in the foreign exchange market where different currencies are exchanged. Different currencies are exchanged, and as a result, the value of different currencies are determined in this foreign exchange market. So the foreign exchange market is a global market, global decentralized market. I told you it's not an exchange. It's through the OTC counters, OTC over-the-counter market. Through dealers, this market operates. There are no physical location. It's a kind of a decentralized communication mode driven market. And in terms of volume, it's the largest market in the world, the foreign exchange market. It is helpful for international trading and investment flows because when you do trade and you bring or when you send investment flows, you need to have currency conversion. You should be able to translate from one currency to another currency. You have to, in other words, you have to be able to basically convert your currency to a preferred another currency. And this is a continuously operating market for exchange. Now, if you look at the structure of the foreign exchange market, there are various players are there and various transactions are there. These transactions, according to this chart, we can divide into two types of transactions: customer transactions or customer trading and interbank transactions or interbank trading. So customer trading happens with the customer and a dealer. Customer and a dealer. Now, let's say customer A can directly access a dealer. Dealers are, let's say in our context in Sri Lanka, these dealers are banks. So customer can come to a bank and ask for, foreign exchange transaction. So that part we call as customer trading, customer transaction. In addition to customer transactions, dealer-dealer transactions are there. So dealer-dealer transactions, you call it interbank transactions. Bank A is selling or buying foreign exchange from Bank B. Bank C is doing with Bank A, Bank F. Likewise, there are various interbank transactions. Those interbank transactions can happen directly, as this chart. There could be direct dealer transactions, or there could be an intermediary to find out the best price. So this intermediary, we call it as a broker for foreign exchange transactions. So even in Sri Lanka, we have these brokers. Money brokers, I told you, central bank is operating or supervising money brokers. So these money brokers are helping not for customer transactions, but for dealer transactions. Right? So I think that gives an idea who are the main players in this market. Why foreign exchange market is important? As I said, it determines the exchange rate. Exchange rate is very simply price of domestic money. Price of domestic money, or you may call it the rate at which one currency is exchanged with another currency, and how many units that you should pay or receive on behalf of one currency against another currency. For example, if you say a dollar equals 195 rupees, which means to buy a dollar, you should have 195 rupees. The exchange rate is 195 equals 1 USD. LKR 195 equals 1 USD. You can reverse and see the reverse exchange rate, which means how much dollars you need to pay to buy a 1 rupee. So you can calculate that by 1 divided by the 195. So either way, you are basically exchanging or expressing the value of exchange between the two currencies. So these different methods of explaining the exchange rate, we can identify under direct quotes and indirect quotes. So under direct quote, cost of 1 unit of foreign currency is given in the units of local currency. Under direct quote, cost of one foreign currency is given by the units of local currency. Indirect is other way around, which means cost of local currency is given in the foreign currency. Now we have an example, I think that would explain what I mentioned. So here we have two currencies, Euro and USD. Euro and the US dollar. So assuming Euro is the local currency, let's say we are in the European region and our base currency is the Euro. Euro is our currency. So if you trade with dollar, how do you explain the direct exchange rate? 1 USD, which means cost of one foreign currency equals 0.93 euros. So the foreign currency is expressed in local currency. Let's say we have rupees and dollars. Rupee, we are the local currency. So how do you explain a dollar? So $1 equals 195 rupees. That is direct exchange rate. If you change it other way around, you call it indirect exchange rate. In this example, 1 euro equals 1.08 USD. So how do you get it? If you divide 1 by 0.92, you get the indirect exchange rate. So it's like two sides of the same coin. The way you look at will give you the idea whether it's direct or indirect. Exchange rate, what we always discuss is the nominal exchange rate. Now here we are talking about actually the nominal exchange rate without any factors considered, we have just noticed or observed two different currencies. Now, exchange rate in discussions, in policy discussions, we divide or we consider different types of exchange rates. One is the effective exchange rate. Effective exchange rate means it's a basket of currencies, not one currency. Now, for example, a particular country would do transactions with number of countries. If it is Sri Lanka, Sri Lanka does transactions with USA, UK, Germany, France, Russia, China, likewise various countries. Various countries have various currencies. So if you only take the dollar exchange rate, it might not give us the proper picture of the exchange rate. So for that matter, we calculate or we consider effective exchange rates where you have a basket of currencies. So in the effective exchange rate, you have a number of currencies. Dollar, USD, Euro, Sterling, Yen, Yuan, likewise, various currencies are given. The weight of that currency is based on the trade size of each currency. Now, if dollar has more weight trade, it has more weight. If yuan has less weight, less share of trade, it has less weight, likewise. So the effective exchange rate is basically indicating the number of currencies used in the economy for their transactions. So effective exchange rate, actually there are two effective exchange rates. One is nominal effective, the other one is real effective. So nominal effective means it's simply the weighted average of all currencies. But the value of currency is also determined under the theoretical concepts, we call them as parity conditions. Under parity theory, the value of the exchange rates are also affected by prices, inflation levels of different currencies. So if you consider not only the exchange rates as well as inflation, precisely inflation differentials between the countries, you can calculate real effective exchange rate. I assume you know the word, the meaning of real. Real means always you adjust for prices, inflation. So if the exchange rates are adjusted for inflation, you may call it real exchange rates. If the nominal effective exchange rate is adjusted for inflation, you can call it real effective exchange rate. Now, why these effective exchange rates are important, that gives an idea about the external competitiveness of this currency, of this country. External competitiveness means how effective, how cost effective you are, whether you can supply at cheap prices for other countries. So countries in the international markets, in the export markets, they are trying to be less costly because the demand will be created by people if your prices are cheap. So this effective exchange rate is giving some idea about our export competitiveness, whether we are in a good position or a bad position in terms of our competitiveness. So in this two charts, I have actually put up two charts here. One is the red line. It is nominal exchange rate, which means LKR, dollar normal rate. In the other one, I have the effective exchange rate. The blue one, sorry, the yellow one is the real index, real exchange rate. The red one is the near exchange rate, nominal effective rate. The other one is the real effective rate. So the both are moving in the same direction, and that gives an idea about the real exchange rate and the effective exchange rate. I'm not going to discuss the the meaning of the meaning of the movements of these rates. I'm just giving you the rate because that discussion is not related to our discussion. But the way the uh, the the trend of these exchange rates are having some kind of different meanings. Okay. I'm not going to, but we will definitely discuss this first chart under our syllabus in the next slides. Now, at this point, I'm going to take a break, which means we are calling off for the day. And I really recommend that you do some homework before you come to the next class. So what is the homework that you need to look at? Here you have 5 areas that you should get some idea. Exchange rate regime. So do some homework and try to find out the definitions. What is fixed exchange rate regime or pegged exchange rate regime? What is floating or flexible exchange rate regime? So come up with some answers. Then you have types of foreign exchange trades: spot transactions, term transactions, cash transactions, forward transactions. So I really recommend just Google or just find out the correct definitions for these terms. So next week when we start, we will have a discussion on these correct definitions, and then we will move to the other part, and there we will have some calculations as well. As I said, the forward exchange rate and the premiums in your exam paper, that is an important area that we will have to have some understanding. Okay, so let's stop at this point, and I really recommend you come up with some answers for the areas that I have mentioned. And at the same time, please follow Financial Press continuously. I have already mentioned to you because that would be helpful for your exam as well. So let's stop here. I'll meet you next week, same time, for the next discussion. Thank you.